Hi, everyone. I'm Terence Vanderwood, co-host of Dollars with Sense radio show and podcast, here with my fellow financial guru, Ela Lange.
Hi, Terence, and hello, everyone. Thanks for joining us today. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. We've got an exciting topic for you today, and it's going to be called the money tree.
Yes, what we're going to be showing you is how to grow your money like it is on a tree. People say money doesn't grow on trees, and you know what? That's true. Money literally doesn't grow on trees. We all know that. But there are 3 different ways that money can make money. And Ella is going to enlighten us on what those 3 items are.
Of course, Terence. Money makes money through interest, capital gains, and dividends. But we're not going to be discussing that in detail today. Today, we're going to be discussing a real-life scenario of a family of 4 and how they used whole life insurance policies for their children's money tree. This helped the parents save their children's education as well as giving them peace of mind for the long-term insurance needs for their children and grandchildren.
Again, this is going to be a real-life scenario where John and Morgan, the parents, use whole life to help fund their children, whose names are Willow and Jaden, to help fund their post-secondary education and also give John and Morgan some peace of mind protection for Willow and Jaden.
And we'll discuss further into details and descriptions of what a participating whole life policy is, and the power that is behind it, both from a wealth-generating perspective and how it ensures that your child, no matter what happens to them in their lifetime, will always have some life insurance protection.
Now, you may be wondering, why would I need life insurance for my child? They're very young and they don't have any need to be insured. That is a very common understanding with the majority of people, but like anything that is to do with growing and protecting wealth, time is the multiplying factor. The real life scenario we're going to talk about with the Simons will demonstrate the main benefits of having permanent life insurance on your children. The 2 main reasons for this type of life insurance for children is, in most cases, they are the most healthy they will ever be, and 2, insurance costs less the younger you are.
So let's talk about the first main benefit. Your child is the healthiest they will ever be. A permanent life insurance policy is very different from a term policy some of you may be acquainted with. A term policy is mostly used to cover big liabilities like a mortgage. And these term insurances are much like renting a house. Each month you pay a premium, and unless you have an event, you will not see that money again. But you do have that peace of mind. Well, permanent insurance is like owning. The monthly fees you pay, or those premiums you pay, go toward your house, also known as your insurance policy. And a portion of those funds are then placed into what is known as a cash surrender value. And there are common components to a cash surrender value, which we will get into a little later.
And permanent insurance is, as the name suggests, it is permanently on the life of the person insured. This means no matter what happens to your child, they will always have this life insurance in place. A properly set up participating whole life insurance will also allow your children up to the age of 50 to increase their life insurance without having to go through medical underwriting. This is the process where your vitals, blood, and urine are tested for all potential health risks of the insured person. So that means no matter what Willow and Jaden, John and Morgan's children, have happened to them in their first half of their lives, the life insurance company will always assume their health is as fresh and clean as the age the insurance policy came into force.
I think there's a great peace of mind knowing that these children will be protected and not have to be denied the ability to have this peace of mind for their parents' loved ones. This means that no matter what choices Willow and Jaden make, both good or bad, they will have coverage. It could be that Willow develops, for example, diabetes, which can be managed, but it does mean that she may have a challenge for insurability. Jaden could decide to become a scuba diver instructor, in which case that he would not be insurable.
That's right, at all, because scuba divers is a very risky lifestyle, and therefore the insurance companies, the risk is too great, so they don't insure. There's a few occupations that are like that. But in this case, where Jaden does have the insurance in place, then he would still be covered because it was done previous to him becoming a scuba diving instructor. So the second reason why it makes sense to have permanent life insurance on children is because it is the least expensive it will ever be. Permanent life insurance has a guaranteed premium or cost that is part of a contract. The policy owner is responsible for the monthly or annual premiums, and the insurance company contractually cannot change the premiums. In the case of Willow, she was insured at 2 years old for a final benefit of $93,000, which cost John and Morgan, the policy owners, $100 per month. Willow is now approaching the age of post-secondary school, and John and Morgan have the ability to use up to $28,000 from the cash surrender value for her education.
Now, before we jump into the story, Terence, we should just make clear that the numbers we are quoting are for illustration purposes only. And so these are not guaranteed numbers. These all vary case by case. So it's just to give you guys an idea out there of what cash values would represent with certain sums. And again, outdated numbers, illustration purposes only. Okay. We have John, who's 52, and Morgan, who is 48. That's mom and dad, with their 2 children, Willow. She's now 22, and Jaden, who is 19 years of age. John and Morgan received some great advice 20 years ago when they decided to place a permanent life insurance policy on both their children. Willow at the time was 2, and when they started hers, Jaden was 1 month old. Imagine you can start that young. Mm-hmm. With Willow, they decided to put $100 per month toward her whole life policy and $200 towards her RESPs. That's her education savings plan. With Jaden, they decided to forego the RESP and put the whole $300 towards a permanent life insurance policy for him.
So Ella is correct. I just want to go back to that the numbers that we're saying here are for illustration purposes only. It is a case-by-case scenario. We recommend you contact us or a licensed insurance salesperson for a personal insurance needs analysis. So this is what the numbers look like today. Jaden, at 19 years old, has a cash surrender value of $34,000. A total policy loan value of $80,000, and a final benefit of $631,000. Willow at 22 has a cash surrender value of $11,000, a total policy loan value of $28,000, and a final benefit of $194,000. So John and Morgan, as the policy owners, are the ones who can determine the best way to utilize the money, which we'll get into in a moment.
So this is a great discussion around strategy as to how to meet the education needs of your children. We talked about RESPs and how they can certainly pay for some of maybe education costs today. This is a great way to supplement, the RESPs. And the great thing and the difference with an RESP is with a policy like in whole life, there are no restrictions on what you can spend your money on. The cash surrender value you have available to you is exactly that, cash. And as we mentioned before, the other real advantage is that you have time, which is the most important partner for growing your wealth.
Now, let's break from the script here and let's give the listeners what it would look like if John and Morgan decided they wanted to reserve this cash for Willow and Jaden's retirement at 55 years old.
Okay, so they're not pulling any money out until 55 years of age. They get to retire at a great age. So let me punch in those numbers. Jaden at 55 now has a cash surrender value of $547,000, which is a total loan policy loan value of $710,000. I should specify that that's up to 90% of the loan value because you need to keep at least 10% in the policy for it to stay in force. If you take the whole amount out, then the policy expires. But if you keep, again, 10% in, that's $710,000 for Jaden. That's a final benefit at the end, God forbid, if something should happen to him, $1.7 million. Whoa. Willow at 55 has a cash surrender value of $145,000 and a total policy loan value of $190,000. And her final benefit to her heirs, beneficiaries, would be $500,000.
And that's at age 55. Of course, that would grow to a little bit to more as they age more. And statistically, they will live to at least 83 for Jaden and 87 for Willow. That's years of age. Just want to clarify a little bit around the difference between the cash surrender value and the total policy loan value and the final benefit.
Good. We have to, absolutely.
Yeah. So the cash surrender value, again, that's something that is available to the owner of the policy whenever they want it. It is grown from the dividends that the insurance company puts into the market and basically invests it on your behalf and allows you to have access to that those monies. The cash surrender value is a portion of the total dividend payout. A policy loan, on the other hand, is basically you take an insurance policy to either a regular banking institution, or you can go to the actual insurance company itself, and then they will loan you 90%, as Ella said before, of that $710,000 value. So you can choose to pay that back or not. What happens with that is that when the death benefit is paid out, then they minus the 90% value that you have loaned. And then the final benefit, which we all know, is we also refer to as the face value or the death benefit. And that's if the life insured passes on, then that benefit, in Jaden's perspective, is $1.7 million. And that is, as Ella said, guaranteed. So it's really incredible, isn't it? I have referred to this type of idea as a personal pension plan, but the acronym PPP just didn't have the ring I was looking for. Anyways, besides, the money tree is more accurate, as we will explain a little bit further.
Yes, so there are 3 different ways to utilize the money that lies within your life insurance policy. You can, 1, use them as a cash surrender value. You can use those. You can use a policy loan value, and you have the final guaranteed benefit available. The cash surrender value is the money inside the policy that's been invested by the insurance company. The rate of return on these investments, by the way, is amazingly rock solid. Let's use 2008 as an example, when the world was seeing up to 45% dip in the markets. That's in the negative, folks, when it was red and the whole screens were going red. You know what? The returns on insurance policies was positive 6.5% in that same year, 2008.
Yes, and the cash surrender value is available to the policy owner by a simple phone call. For example, Jaden needs to use $5,600 for his tuition. John or Morgan would phone the insurance company, ask for a check for $5,600, and it would arrive in the mail a few days later. That $5,600 would then be deducted from the final benefit. The policy loan value is the amount the insurance company guarantees to pay out in dividends. John and Morgan, as policy owners, can take this figure, as I said before, to a financial institution, including the insurance company, and borrow up to 90% of this value. Again, when Jaden is 19 years old, that value is 90% of $80,000.
The final benefit is the amount, as we discussed, that is paid out on the death of the insured, and that amount is paid to the beneficiary, tax-free. If we look at Jaden's number, at 19 years of age, that number is $631,000. John and Morgan can safely assume that he will never have to worry about term insurance for his future family, and potentially John and Morgan's grandchildren would also be fully protected if, God forbid, an accident should occur to Jaden.
The money tree is a permanent life insurance that provides 1. Lifetime protection. Permanent means it will be with the insured person for the rest of their life, no matter what. Even if they get diagnosed with cancer and go through all the chemo and everything like that, that life insurance will still be in force. In other words, the life insurance company will contractually have to pay if there's a death in resulting it. 2. Guaranteed basic premiums. It is a legally binding contract between the policy owners and the insurance company. And the guaranteed basic death benefit, the initial value, what is known as the face value of the policy, is guaranteed permanently.
It also provides an opportunity to earn policy owner dividends. The dividends of this policy are paid annually, and when they are credited to the policy, they will not drop in value, unlike market investments. They will, however, continue to grow year after year. The insurance company, for example, Canada Life, has not ever missed a year of dividend payouts in its 150 plus year history. Very important.
Yes, very good track record, that's for sure. And finally, it provides tax-advantaged cash value growth. Because it is a dividend payout, it is tax preferred. As we revert back to the beginning when we said there was 3 ways to make money, Ella was telling us one is an interest, which is taxed at 100%. Another is capital gains, which is taxed at 50%. And the third is a dividend, which is taxed at between 60 and 70%, depending on the calculations.
And unless the Liberal government changes that, Terence, I don't know.
Well, I don't think the Liberal government will change that because the insurance companies are a pretty powerful lobbyist, and I think they'd be kind of upset by that. By the way, a permanent whole life insurance policy is also really advantageous to the elderly too. I have a number of clients who have a whole life policy in place on their life, so they can choose to pay their favorite charity instead of the government. It is a strategy that is the most powerful way for those who are near the end of life to direct their wealth to their heirs and not to the taxman.
As a matter of fact, this and other similar strategies can possibly do away with the need for a will. You're going to say, what? That's impossible. But please, everybody, do not let this stop you from getting a will updated and in place. It just means this type of strategy can supplement or complement your estate planning purposes. It's a very important element to your estate planning. So we're going to leave you with some action items for the coming week. We suggest that you pull out any old insurance policy you may haven't seen for years and highlight the contact number of your insurance advisor that's on that statement. You got to contact them and tell them that you're interested in a participating whole life insurance policy that has paid up additions. You may be a grandparent looking to help out your grandkids. You may be a young family with young children. If this is something that interests you, ask your insurance advisor. Or if you do not have one, certainly you can call us. We have a phone number or an email address, certainly through Facebook. Terence is going to run through all of those with you in just a moment.
So that's it for this week, everybody. Thank you to everyone. It's 98.7 CKPM FM, The Point, Tri-City radio station, for giving us the time to be your financial gurus by offering you, the listeners, valuable financial insight. Check out our Facebook page. As Ella says, you can contact us through phone, through email, through Facebook, and through YouTube. So check out our Facebook page at Dollars with Cents. Podcasts and the transcripts of our shows will be available to listen to again and again. And please send us your questions or you'd like us to answer or make an appointment for a personal review of your financial plans with no cost or obligation to you. Again, you can leave us a comment and you can also like our Facebook page. We would be very grateful if you did that. Reach out to us in other means. You can reach out to us by email at 2financialgurus@gmail.com. That's the number 2financialgurus@gmail.com. You can reach us by phone. You can call 778-879-0820. That's 778-879-0820. and we'll be happy to answer your questions that way. You can also reach us by our YouTube channel. You just go to the YouTube search bar and you type in Ela and Terence, and we will come up at the top of the list. You'll be able to check out our other 38 episodes that we have on there, all around financial planning, and you can read it at your leisure whenever you want. If you subscribe to the channel while you're there on YouTube, you will automatically be notified when a new episode is ready for your listening pleasure.
Thank you for tuning in today and joining us on this episode of Dollars with Sense. We hope you found it useful, and we look forward to seeing you back here next week for another knowledgeable packed episode. Until then, Terence and I wish you a productive week.
And may your dollars and cents be with you.